One of my favorite strategies to implement into your portfolio, I'm about to share with you. It doesn't matter if a stock goes up or if a stock goes down. Either way, you make juicy premium no matter what. Are you guys ready? Strap in. This is going to be a banger. You guys are going to love it. Welcome back to the channel, everyone. Corey here. If it's your first time, be sure to subscribe and tap the bell so you know when I post new videos, and give me a thumbs up as it greatly helps the channel grow. I'm going to show you guys a very powerful strategy in this video. And if you like it and want to learn more powerful strategies just like this one, I just launched my masterclass boot camp. Only 10 spots available. Now we're down to 4 spots. So if you guys are interested in jumping in with one-on-one coaching, advanced strategies, full training course, and Discord access, you guys can do so at any time at investwithcorey.com/learn right there on the screen or in the information box below. Beginners, intermediate, even advanced traders and investors welcome, as I want to show you guys how you can become more profitable and help you guys increase your financial freedom, your time freedom, and your location freedom. And that's what drives me every day. I told myself once I found success, I would do everything in my power to help others achieve the same dream. And besides the boot camp, I also offer advanced training, one-on-one coaching, as well as a full training course from dividends all the way to advanced strategies. If you guys are interested, I would love to help you. You guys could sign up for either the boot camp or the advanced training at any time, and I would love to be your one-on-one coach. I just want to point out that I'm not a financial advisor, and this is not financial advice. I'm just here to provide you guys with tips, strategies, technicals, fundamentals, financials, and help you guys overall in the market. However, it's ultimately up to you to decide which stocks you want to put your money into and how much of a position size in those stocks, strategies, or options you want, as it's your money. Today we're talking about the straddle, not to be confused with the strangle. A straddle and a strangle both benefit whether or not a stock goes up or down, but it has to move a lot up or down. They both benefit. We already covered a strangle in a previous video. That video is right there. A strangle allows you to hedge your risk a little bit better, capping your loss, but giving you a bias in the bullish up direction or bearish down direction. However, if you're not quite sure where a stock is going to go, then you really don't want to run a strangle and hedge and cap your loss and give it bias in a direction because you're not really sure where that stock price is going to go. If you ultimately aren't sure if a stock is going to go in either direction, but you just know it's going to go in one or the other and it's going to move a lot, like Nike did recently on earnings, the stock dropped a lot. I thought there was a high probability of this happening. I also thought there was a pretty decent chance it could skyrocket. So I wasn't sure enough to run a strangle, but a straddle is the perfect solution to this kind of situation. If a stock is going to move in one direction or the other, and you're just not sure which direction, but you know it's going to be volatile around earnings or a catalyst event that's coming up, the straddle is your play because it's equal. It doesn't matter if the stock goes up $5 or down $5, you make money as long as it moves. So let me show you guys how to implement this amazing, powerful strategy to print you guys juicy premium. Let's get started. So you can see on stocks like Rivian right here, big move happened. If we were to have run a straddle down here, this would have been a massive gain, several $1,000s. We would have opened this position for about 200 or 300 and made several thousand. This is a 10x return. Nike, same thing. Right before earnings, we all know on earnings, stocks either go up a lot or down a lot. They hardly ever consolidate after earnings. Right before and right after, the price always goes up drastically or down drastically. So a straddle is the perfect strategy for situations like this. Again, so this right here would have been a big move. This would have been a 10x all day. This is a very powerful strategy. Let me show you how to implement this onto your favorite stocks. We could go down to Tesla and we would see that on earnings on July 17th, it's likely that Tesla could pull back a little bit, come back higher, and we could see strides up around 206. And based on their earnings history, 3 red in a row, they could have another bad earnings and the price could drop. Now, we're not going to be buying this several weeks out. So the price is going to be a lot cheaper as we get closer to expiration. So we're going to want to buy this about a week out from earnings. So let me show you what we would do. 1 week out from earnings, we got to figure out where we expect the stock to go, and it's going to depend. But let's say earnings was this week. I would expect that there's a good likelihood that Meta... Now, if earnings was this week, there's a good likelihood or chance that Tesla could end up around 189 or 170. It could also end up at 210. So realistically, if earnings was this coming Friday, July 5th, it's highly unlikely Tesla would stay at at 194 or 197. So what we would do is we'd buy a 195 call and then we would buy a 195 put. So you can see that our total cost is $1,000. But if Tesla goes to 210, 211, we're almost doubling our money. And it's basically guaranteed. We all know that on earnings, Tesla is definitely going up or down $10. Like, this is almost a guarantee. This is like free money, basically, because we know that Tesla's going to go from 195 to 205 or 210, or it's going to go from 195 to 180 or 175 or something like that. It's going to move at least $10 to $15 up or down. We know this. It happens every time. Every stock at earnings is volatile. So if Tesla was to go to 210, 211, we would almost double our money. If it goes to 175, we would double our money. So really, if Tesla just does what we expect it to do, it's a 200% return. So if Tesla just does what we expect it to do, which it does every earnings, it's a 100% return, basically in 4 or 5 days. That's insane. The S&P gives you 8 to 12% per year. I'm giving you 100% the same week on earnings. Now, we can also play this on a slight bias. If we feel that the stock is more likely to go down, we can treat it like a strangle. If we think the stock price is more likely to go down, we buy higher. So we would buy a 205 put and call. Do you see how close it is to going, like, to moving down in the bearish direction? So you can see the difference now. Look at this. Tesla only has to go down by like $5 to break even instead of 10. So now if Tesla was to go to 185, we would just about double our money. If it was to go to 170, we would almost triple our money because we've given it a bias. We buy higher in the calls, expecting it to go down, which makes us more premium. If we are expecting the stock price to go up, we would buy a 190 call and put. And as you can see here, it gives us less bias on the bearish side and more bias on the bullish. So now Tesla only has to go up by about $5, not even, and we break even. So if Tesla was to go to 210, instead of giving us an 80% return, we're now at about 120% return. And it's also cheaper. And we get $1,000 profit at 212. If Tesla was to go to 220, that's almost a 200% return in 5 days. If we were to do this on multiple contracts, this is a lot of profit. This is a very good strategy to implement into volatile stocks with a lot of Vega and a lot of IV. Now, Vega and IV are hard to understand, too much to explain in this video. So if you guys want to learn more about Vega and how it affects implied volatility and options pricing, and you want to learn more of these strategies to implement in your portfolio, and you'd like to have me as your one-on-one coach, I would love to have you, and I would love to teach you how to become a better investor and trader and to become profitable. And you guys can sign up for my training, one-on-one coaching, and Discord at any time at investwithcorey.com, right there on the screen or in the information box below. I would love to speak with you, and I look forward to helping you grow. So you guys can see how powerful of a strategy this is. This gives you so much direction up or down. All the stock has to do is move $5 to $10 in either direction, and you're making profit. Even if you only made a 30% return, because this strategy has got a high chance of success because we're implementing it on highly volatile stocks and around a catalyst like earnings, we know for these two facts alone that the stock is likely to move up or down and not consolidate. Therefore, the chances of success are high, which is why this is a very powerful strategy. Even if Tesla was only to go to $180, we'd still make a 15 to 20% return in a week. If it was to go to 205, we would make about a 30 to 40% return. We're still making profits with a high success rate strategy. This is the straddle. This is what it does. If a stock goes up or down, it doesn't matter. As long as it moves, you make money. Just as an example, if we had to run this on Nike with the big drop Nike had due to the bad earnings, let me show you what would have happened. Nike dropped like $20. So let's do this on Tesla. We're going to buy the call and the put. There we go. So right now we spent $1,000, 1,010. A $20 drop would put us at 177. So right about here, we would have doubled our money. $1,000 profit, 5 days per contract. We had done 5 contracts, we would have made $5,000 in 5 days or less. You can open this strategy 2 to 3 days before earnings. So if earnings is on Wednesday, open it on Monday and then close it right after earnings on Thursday. So in reality, this could be a 2 to 3 day trade for a 30 to 100% return, even 200 or 300%. Because if Nike or the stock that you're running this on, like Tesla, was to drop even more, say 170, you could make about 150% in 3 days. You could also run the strangle, which is a different strategy, and I could just move my call option up to 197, and you can see it's a strangle. It's now capped at 875, but it gives us more bias to the call side. You see that? See how it's a little bit closer to going on the upside, and now it's, you know, more of a dip down here, more of a risk. So instead of going to 206 on the strangle by running a straddle, there's more risk in the downside. downside, but it only has to go to 205. So the strangle hedges your loss if you're biased on the direction, slightly biased. This way, you don't have to worry as much about the downside because you're more sure it's going in one specific direction versus another. So in this video, the straddle strategy, we don't know where the stock's going. We just know it's going in one direction or the other for sure, or almost for sure. So you guys can see how powerful a straddle is. As long as you run this with a big catalyst around earnings time on Tesla, Meta, Netflix, Adobe, Microsoft, any of these big companies, Apple, Amazon, Google, you will make ridiculous profits. As long as you have a general idea of where the stock is going to go and you pick a good strike price about a week before earnings, you can do this strategy and implement it in your portfolio. Juicy profits. And of course, if you're not quite sure on which direction it's going to go, the straddle is perfect. But if you have a bias to this and you think that the stock is going to go up more than you think it's going to go down, you can hedge your risk by running a strangle. This is a very powerful strategy and you have to use it on the right stocks at the right times. This is also a perfect strategy to run on medical stocks around big catalysts like medical research that's happening, approvals from the FDA. This is the perfect strategy for trading medical stocks as well, or anything with a lot of volatility. The more volatility a stock has, like GameStop, for example, the better this strategy usually fares and the higher the success rate. If you guys enjoyed this video and you enjoy the strategy and you want to learn more of these strategies, you guys can join my Discord one-on-one coaching and training course at any time. I would love to be your one-on-one coach, help guide you on strategies and teach you how to become more profitable and have more financial and time freedom. I would love to help you. This is what drives me every day, is being able to help you guys become profitable. I told myself when I achieved financial freedom, I would do everything in my power to help others, and that's exactly what I've set out to do. So I hope to speak to you real soon. Thanks so much for being here, guys. Be sure to subscribe, tap the bell, and give me a thumbs up if you guys enjoyed the video. And if you enjoyed this video, I picked out another video right here just for you guys. This will teach you everything you want to know on covered calls. Click it. You guys are going to love it. And remember, until the next video, let's grow our wealth together. Take care, guys. Click the video. You guys are going to love it.